I like the field of finance because to me, it is very logical. At the end of the day, even if someone brings you something complicated, you will be able to typically explain it in simple terms. And to me, that's very reassuring. Um, Two, as you can see, the field of finance solves real life problems. And three, for all of you who are interested in the quant side of the world, the field is very quantitative. So, building this view are interesting. What I really like about finance is that it's very intuitive. It's like telling a story. And if somebody talks to me about something in the field of finance and I don't understand it, then I get very worried because it probably means that, you know, there's something that may not be completely kosher, because it really is not that complicated. And you should be able to tell a story and you should be able to understand the intuition behind it. So the key point here is all of us have a much more intuitive understanding of a family's income statement and balance sheet because, we live that every day, right? So sort of intuitively, we understand this concept. But the beauty, as you can see, is that even if you go to a corporation like American Airlines, the framework is still the same. There are more complexities involved, but the overall framework, the story is still the same in terms of what the income statement is and what the balance sheet is. If you are working in the corporate finance department at American Airlines, right, your CEO, your top management is going to come and ask you, hey, should we buy these 30 new planes? What is the argument for buying it? And so as an analyst, you have to come up with a framework where you say, what does the world look like with these 30 planes? What does the world look like without these 30 planes? Right? That finance really has a lot of job opportunities just because every company that you can think about, regardless of what business it's in, what industry sector it's in, there is a role for the finance team. And the finance team is really the team that says go or no go on projects and how to fund it, right? So it's a very powerful function within any. Hear me clearly? Okay, excellent. Good evening, everyone. Back in India, I'm very impressed that so many of you have signed in on a Sunday evening to listen to a talk. I'm very impressed. I don't know if when I was your age, if I would have done that. You're clearly more motivated and more interested than I was at this stage in my life. So kudos to you all. And as Hari said, it's a real pleasure to talk to you, and I hope I can perk your interest in finance and convey to you that there is a lot of overlap between having quantitative skills and working in the field of finance, because finance is very quantitative. So I prepared a presentation, and at the end of this presentation, hopefully you'll have a sense for what finance is about, and then we can definitely have more conversations in a Q&A session that I think Hari is planning to moderate. So can you folks see my screen? Okay, excellent. Okay, so what I would like to do is tell you a little bit about my background, then talk about the role of finance as I see it, then talk about careers in finance, a little bit about quant finance, examples, and then we can take a Q&A. So as Hari said, I grew up in Mumbai. My father worked and retired from Baba Atomic Research Center, so very much a Mumbaiker. My undergraduate degree was from BITS Pilani. I worked for a year in Mumbai and then joined the PhD program at ASU. And then I elected to stay in academia, and I've been a professor since 2000. I teach courses in the area of investments, energy finance, and I also do research in the area of trading. So let me tell you a little bit about the role of finance. What is finance all about? So as you can imagine, if you think about the overall economy, there are going to be some units which are surplus in money. So they're uh, making more money than what they're spending right now. And at the same time, there are other units which are deficit in money, in the sense that they have some interesting opportunities, profitable opportunities, but they don't have enough money to actually fund it. And so the people who have the surplus money, they are willing to give the capital to those who are deficit units, as long as they are promised a reasonable rate of return. And if you think about surplus units, a good example would be households. They typically have surplus because they earn more than what they spend. And if you think about deficit units, you can think about corporations because they're looking for capital, or government looking to spend for public policy. So the role of financial markets is really, or finance is really to put these two things together by having these surplus units find these deficit units, but do so in an efficient manner. And when we say in an efficient manner, what we have in mind is that if the project is really economically viable, if it's something that's going to generate a return more than the cost of putting the project, then you are favorably inclined to fund it. But on the other hand, if the idea of the project is not very good, it's not economically viable, then the project should not be funded. And so what you really need is to come up with techniques to assess these projects or these opportunities that come your way, and come up with a framework to rank these projects as highest potential versus next, and then fund the best ones and then not fund the poor ones. So this framework, which really is akin to survival of the fittest, right, is what is called a market-based allocation of capital, and finance facilitates that by efficiently allocating the surplus to the deficit units. Financial markets also perform a very important role, which is that they bring together uh, buyers and sellers. So once you fund a particular project, then you are an owner of that project, or you are a lender to that project. And sometimes you may want to get rid of your ownership stake in that project. Typically that's what happens in a stock market, because if you're a stockholder of Reliance, then you're a part owner of Reliance, right? So when you want to sell your share of Reliance, it's possible that Hari is someone who wants to buy that share of Reliance, right? And in the case of Reliance, it's very easy because both of you meet in the financial, in the stock market, and I send my order to sell, Hari sends his order to buy, and the two of us find each other quickly at a low cost. And because there are a lot of people there competing for my share, a lot, I make sure that the price that I get from Hari is the best price. And similarly, just like I'm selling my stake, there are a lot of other people who are also selling my stake. So Hari makes sure that the price that he is paying is the best price that he can get. So there is, as you can see here, you are matching buyers and sellers quickly at a low cost, and making sure due to competition that everybody gets a good price. So these are some of the important concepts that come out of the field of finance. Okay, so now I'm going to take a very simple example and start building this idea that what I really like about finance is that it's very intuitive. It's like telling a story. And if somebody talks to me about something in the field of finance and I don't understand it, then I get very worried, because it probably means that you know there's something that may not be completely kosher, because it really is not that complicated. And you should be able to tell a story, and you should be able to understand the intuition behind it. So let's start with um, a simple example. So this is my family, Kumar family, and I'm talking about my income statement. And you can all in your own household come up with an income statement. So this is Papa Kumar making some money in the form of salary. This is Mama Kumar making some money. So together, let's say we make $200,000 a year. And then we have some expenses, which all of you can relate to, right? Car fuel, groceries, some insurance that we all need to buy. We need to pay for our electricity, phone, internet, etc. And then we have to pay some taxes, income taxes, property taxes. So let's say that all these expenses add up to $140,000. This results in a annual saving of $60,000, right? So this is the Kumar family. And I think Uh, this is a concept that all of us can understand, right? This is a very, very simple idea. The beauty is that if you take any company like American Airlines, this is exactly what's going on. It's not that different. American Airlines has some sources of revenue. They sell airline tickets, as you know, and it results in source of revenue. They have some cost of operations. So if you remove all the different types of costs that are they're associated with, as well as the tax that they pay, then you end up with a net income. So this net income in the case of American Airlines is simply all the revenues less all the expenses. This $60,000 that you see here is again all the revenues less expenses, right? So you can see that yes, things are more complicated in the case of a corporation, but conceptually, if you want to tell a simple story, it's not that different. Okay, so now the next question is, what does the Kumar family do with this $60,000? So what we then do is build what is called a balance sheet. Okay, and in this case, the savings from from that year, 60,000, is on the asset side of the balance sheet, because this is the money that the Kumar family owns. The family may have made another $60,000 every year over the previous 10 years. So they have another $600,000 that's sitting in their bank account. So you can see that the total assets that they own is $660,000. And they have not taken any loans, so they don't owe money to anybody. So if you take what they own and subtract what they owe, then you come up with the wealth. And in the case of a company, you call it a net worth, but it's really, if you ask, if you have a simple conversation and you say, hey, how much wealth do you have? Really what you're talking about is your total assets, things that you own, less your liabilities that you owe, right? So this is a very simple balance sheet, because the Kumar family has just kept all the savings over the years accumulated in a bank account, right? Now, then you can start adding complexity to it. Okay, so how would you add complexity? So one complexity might be, instead of keeping this money in cash, the Kumar family went and bought a house for $400,000, right? So in this next slide here, you can see that the savings now is only $200,000, because $400,000 has been used to buy a house, but this house is now an asset. And just because there is a change in the composition of the assets, it does not change the total wealth of the Kumar family. So it still stays at $660,000. Now you can do some more sort of financial engineering here. So in this example, instead of paying for the entire house using the savings of the Kumar family decides to take a loan to partly finance the house. So then you bring in this complexity here. So now you owe some money to the bank from which you have taken this loan. So the house is $400,000, but you've taken a mortgage on the house that's $350,000. So this $350,000 gets added to the cash, because this is money that has been given by the bank. So the total assets here is over $1 million, but there is a liability because you've taken a loan to fund these assets, and your net worth remains the same at $660,000. So one important thing for all of us to remember is that, we may go and visit some friends and they may have, 2 homes, and they may have 5 cars, and you might say, oh my gosh, these people are so wealthy, look at all the assets that they have. But that's really giving you an incomplete picture, because in addition to the assets, you have to look at the liabilities. And it may just well be that after you account for the liabilities, your net worth may actually be more than their net worth, right? So these are sort of very simple ideas, but this is sort of the framework that one needs to keep in mind. So this balance sheet here is still very simple, because there is some money that I have in a bank account, I have a house, and then I have paid for it using a loan. In reality, a family's balance sheet is going to look a lot more complex, because instead of keeping all their savings in a bank account, what they are going to do is use part of their savings to buy some jewelry, buy some furniture, buy a couple of cars. And then typically they would not just keep it in cash, but they would invest it in the financial markets. And so you would have a financial portfolio. And similarly, on the liability side of the balance sheet, this is money that you owe. You would have a mortgage. You may have a credit card, which is a loan that you've taken from the credit card company. You may pay for your car, not just from your money, but you may take a loan against your credit card, right? So you can see that you've just taken the Kumar family balance sheet and added more complexity to it, but the conceptual framework still stays the same. These are the total assets, these are the total liabilities. The difference between the two is the net worth, right? And um, and this is the way we think about a typical family's balance sheet. But if you go and look at American Airlines, and I just pulled this from for American Airlines a few years ago, you can see here that it has various assets, and those assets would be things like planes and other kinds of property, land that is owned, buildings that it owns, etc. And to fund these assets, which are close to $60 billion, it has taken various kinds of loans. Some are short-term loans, some are long-term loans, and they are called liabilities. And if you add up the total liabilities, it's around $60 billion. So the difference between the two is close to zero. So although American Airlines has a lot of assets, it has a lot of liabilities, and so the net worth or the wealth of the shareholder is not very high in this particular example, right? So what is the key point here? The key point here is all of us have a much more intuitive understanding of a family's income statement and balance sheet, because we live that every day, right? So sort of intuitively we understand this concept. But the beauty, as you can see, is that even if you go to a corporation like American Airlines, the framework is still the same. There are more complexities involved, but the overall framework, the story, is still the same in terms of what the income statement is and what the balance sheet is. Okay, now let's talk a little bit with this idea. Let's talk a little bit about the important decisions that the Kumar family makes. The important decisions are, well, what kind of assets do I want to have? Do I want to have one car or two car? If I want to have jewelry, how much should I pay, or how much should I invest in the house? Should I buy a very large house, which is more expensive, or a smaller house, which is less expensive? Uh, how much of my overall assets should I put in financial markets, in the stock market, for example, right? So these are all the decisions that the Kumar family is making on the asset side. On the liability side, they're making decisions on how much loans to take, right? And if you are working for American Airlines, you again have to make the same kind of decisions on what projects to fund, what to have on the asset side of the balance sheet, and how to pay for it. Okay, so the decisions that we can all understand intuitively from the perspective of the Kumar family is also the decisions that's being made at American Airlines, but at a much higher scale. So here's a news article that I picked up. American Airlines purchases 30 regional jets worth $1.4 billion. Okay, so if you look at the fine print here, you can see that American plans to purchase 15 aircrafts from a Brazilian manufacturer and 15 jets from a Canadian aircraft maker. The plane orders are valued at $705 million and $719 million respectively, which adds up to $1.4 billion, right? So in this case, American Airlines needs money to buy these planes to the tune of $1.4 billion. So if you are working in the corporate finance department at American Airlines, right, your CEO, your top management is going to come and ask you, hey, should we buy these 30 new planes? What is the argument for buying it? And so as an analyst, you have to come up with a framework where you say, what does the world look like with these 30 planes? What does the world look like without these 30 planes, right? And figure out a cost benefit analysis. And at the end of the cost benefit analysis, if the benefits exceed the cost, then you would tell the CFO or the CEO, this looks like something that we should do because it's creating value for American Airlines, right? But on the other hand, if the benefits do not exceed the cost, then you say that, look, I don't think at this point the benefits justify the cost. So this is one decision. The second decision is, should American Airlines purchase the planes from Boeing or by some other company, like a Canadian company, right? So what are the costs of planes, warranty, maintenance, crew, parts, etc. And so to do all this, you first need to understand the economics underlying the business, right? To run a cost benefit analysis. And then two, you need to have the ability to forecast what's going to happen. And forecasting, you can do two ways. One, if you're lucky enough to have a crystal ball, which tells you exactly what will happen in the future, then great, just look in the crystal ball. But for most of us, we don't have a crystal ball, right? So we have to rely on some sort of a statistical approach where we say that this is what I think is going to happen. So you come up with, your expected future outcomes, but you also recognize that there will be a forecast error. That is that even with your best technology and your best efforts, there is some chance that what will actually happen is going to be different from what you have forecasted. And that is what is called the variance or the standard deviation of your forecast, which is called the forecast error, right? So you need to have the ability to run this analysis, because only this kind of an analysis where you explain whether value is being created, but how much confidence you have in your analysis, that can be done. Okay. Then in the previous example, American Airlines needed $1.4 billion to buy those 30 planes. Then you have to let the CEO know how you're going to fund it. Where is the money coming from? And you might say, oh, well, I can borrow $1 billion from a bank, or I can borrow $1 billion from the bond market by, taking a loan from the financial market. It's called corporate bonds, right? And then I can partly fund the 30 planes using American Airlines' own capital. It's just like when you buy a house, you take a loan for part of the house, and then the rest you pay with your own money, right? So American Airlines has to make that same decision. And the question is, well, how much do you borrow? How much of your own money do you put in, right? And who do you borrow from? And what are the terms of the borrowing? So for a minute, just step back and think about any company. Just name any company. It doesn't matter whether it's a technology company, whether it's in the energy industry doing refining, like Reliance Petrochemicals. It could be Google. It could be Apple. Name any company. All these companies have a finance function where they are making a very similar decision in terms of which projects to go after. Amazon is trying to figure out, should I put on that additional warehouse in Bangalore? And how much is it going to cost me? What if I put it in Chennai instead of Bangalore? Things like that, right? So this type of analysis is being done in every company. And so you can immediately see that finance really has a lot of job opportunities, just because every company that you can think about, regardless of what business it's in, what industry sector it's in, there is a role for the finance team. And the finance team is really the team that says go or no go on projects and how to fund it, right? So it's a very powerful function within any corporation. Then let's talk a little bit more about jobs related to finance. So American Airlines needs $1 billion. It makes an application for a loan to Bank of America. So there are financial analysts working at a commercial bank like Bank of America or State Bank of India, right? And they are reviewing this loan request, and they are making a decision on whether American Airlines should get the loan. And in doing so, they are trying to figure out what are the future prospects of American Airlines, what's the likelihood that they will be able to pay back the loan, what is the probability of default. If they default, then they take over the planes because it's a collateral. How much can they get by selling these planes if American Airlines defaults? What is their risk exposure to the airline industry? How much should be the loan amount? What should be the interest rate? So again, you can see that just like the analyst at American Airlines is making forecasts, the analyst at Bank of America is making their own forecast from their own perspective to make a decision on whether to go ahead with this particular loan or not. So there are lots of jobs, as you can see, working at an intermediary like a commercial bank in finance. Then the jobs that many of you may have really heard of, which is to work as an analyst at an investment bank, right? So you work as an analyst at Goldman Sachs. So what is Goldman Sachs doing? Well, they are also participating in the same problem. American Airlines wants to raise $1 billion, and instead of taking a loan from a bank, they have decided to borrow from the financial markets. So this is called a corporate bond. So they want to issue a corporate bond, and they will use that money to buy these new planes. So they're going to come up with a $1 billion uh, corporate bond. But the problem is American Airlines knows how to fly planes. And even the finance guy at American Airlines, they really don't have much of an expertise on how you can go and find these people who will be willing to pay you $1 billion to buy your plane. So they don't understand really the process of how to um, sell these bonds or sell stocks. So investment banks are really consultants, and they offer various kinds of advisory services to companies. So in this simple example that we have talked about, they will advise American Airlines on how they can raise $1 billion from the financial market. So if you're working as an analyst at Goldman Sachs, first you will put together a presentation deck for the American Airlines management detailing how Goldman Sachs is really the best player out there to provide this advisory service. But just like Goldman Sachs is uh, pitching uh, to the American Airlines management, other investment banks are also pitching. Everybody's trying to get that deal, right? So first job is to get hired as the consultant for this particular deal. And once you get hired, then you work with American Airlines with respect to helping them raise the money, take this particular company on what is called a roadshow, meet potential institutions who will be willing to buy the bond and help them raise capital. And in this process, you work very, very, very long hours. I mean, we're talking about 100 hours per week, week after week, all year, right? But because you make a fat fee from these kinds of advisory services, the compensation for an analyst at Goldman Sachs would be quite significant. Okay, so here I have this term restructuring and I have this term consulting, right? So what kind of restructuring work would one do? The restructuring work that you would see with respect to American Airlines is similar to an advice you may give the Kumar family. So let's say that the Kumar family has two very expensive cars, right? And they're not making, and they've taken a big loan in order to pay for these cars. And it looks like, they are getting in financial trouble because, they're not saving enough. So if you're a consultant to the Kumar family, you'll tell them, look, you don't need these two 7 Series BMWs. Why don't you sell these cars, pay back your large loans, and then, buy two Toyota cars, right? So that it costs you a lot less. So selling off some assets, reducing your debt would be one example of restructuring. Another example of advisory service would be if you have a lot of cash and you don't know what to do with it, they may pitch you various interesting acquisition opportunities and say, hey, you have all this money sitting in your bank account. Why don't you invest in this particular property, or why don't you invest in this particular opportunity, right? So it's both acquisitions as well as divestitures. It's changing how much loans you have, the composition of the loan, things like that. So that's the kind of advisory service. And you can see that every company that is out there, whether it's Google or whether it's Microsoft or whether it's a petrochemical company, they're all thinking about, is my assets and my liabilities structured in an optimal way? And so the investment banks are constantly working with these corporate clients to help them with their restructuring and giving them advisory services. So that's what investment banks do. Okay, and then the last issue that I want to highlight is this in this particular Kumar family balance sheet is this portfolio. You can see here that the Kumar family has $443,000 in a portfolio in the financial market. So what is this portfolio? This portfolio is just ownership of some stocks and bonds. So in this example, you can see the $443,000 here. It's made up of some ownership in American Airlines. So I bought some shares of American Airlines. I bought some shares of Alphabet. Okay. And then I have put my money in this mutual fund. and which is investing in the stock market, and in this mutual fund, which is investing in the bond market. And you can see here that the portfolio is 443,000, of which 79% of the portfolio is in the stock market, 17% in the bond market, and the remaining 4% in these two stocks, right? So these weights that you see here, W1, W2, W3, W4 is what makes up the portfolio. So what assets you put it in and how much weight you give to each of those assets, right? And that's a very important and complicated problem that is being solved in financial markets, right? So the Kumar family is a surplus unit. They have extra money to invest over the next 20 years before Papa Kumar and Mama Kumar are going to retire. So they are putting their money in the stock and the bond market so that they can get a return on their investment. So when they put their money in a mutual fund, the mutual fund is also investing in the stock market. So if you take this particular Vanguard mutual fund, and I just took a snapshot of what this mutual fund is owning, it has some Microsoft, some Apple, some Amazon, Facebook, Johnson and Johnson, Alphabet, Berkshire Hathaway, Procter and Gamble, and these are the weights: W1, W2, W3, W4, W5. So this is a portfolio of ownership in various kinds of companies. You can see Netflix here, right? And somebody at this particular mutual fund, there is a fund manager who's making this decision on which stocks to buy and how much to invest in those stocks. Okay. So there is a large opportunity out there in the world of investments. It's also called money management, right? Because someone like the Kumar family is saving money today, and it wants to move the money 20 years down with some return when they are in retirement, and they want to withdraw money from that portfolio. So you're helping them invest in financial markets, and you're helping them design these portfolios. Okay. So you may say, well, this is true for the Kumar family. Who else is interested in building these portfolios? I'm going to give you another example. This is my university's endowment. So, the university receives gifts from alumni and donors, and puts, the savings that they have over time. So this is my university's endowment. It is worth $1.3 billion. And as of a few years ago, I'm showing you a snapshot of what that endowment's $1.3 billion looks like. About 40% is invested in the stock market. About 10% is invested in the bond market. They have some real assets, for example, properties, and they have invested in some more complicated types of financial assets called hedge funds, as well as private equity and venture capital. But you can see here that what really matters is which assets you want to put money in and what should be the weights, right? So it's the same problem as what you saw here with the Kumar family. And in the world of investments, the types of jobs that you have are, you can work as a financial advisor and help investors make financial decisions. So it could be someone like me, my family, which does not have a lot of money, as you can see here, or it can be the Birla family, which have a lot of money, but they're still solving the same problem, which is that they're trying to move their surplus capital from today to sometime in the future. And so you have a whole bunch of jobs at these places: pension funds, university endowment, Bill and Melinda Gates Foundation, mutual funds, hedge funds, broker dealers, etc., who are professionals helping with money management. Okay, so let me wrap it up by summarizing why I like the field of finance, because to me it is very logical. At the end of the day, even if someone brings you something complicated, you will be able to typically explain it in simple terms. And to me, that's very reassuring. Um, Two, as you can see, the field of finance solves real life problems. And three, for all of you who are interested in the quant side of the world, the field is very quantitative. So if you are interested in mathematics, statistics, economics, or computer science, these are all fantastic areas to combine with finance, because when you make financial decisions, you have to forecast, which means that you need to understand statistics. You have to run economic analysis. And when you run economic analysis, you rely on calculus and optimization. And then finally, when you are making financial decisions, you have to combine and process massive amounts of information, which typically comes in the form of financial databases, and increasingly, uh, programming languages like R, Python, Stata, SAS, etc., are being used, including machine learning techniques. I believe that you had a discussion of that in one of your earlier seminars. So all this is playing a very important role in finance. So let me give you some examples. 25 years ago, when people used to buy and sell stocks, they would call up their broker. The broker will then hand it out to a human being. The human being will then go on the floor of the Bombay Stock Exchange, and they will buy and sell, right? That world has changed. So today, buyers and sellers are still submitting orders to buy and sell, but these are being handled by trading algorithms. And algorithms are really computer programs. And these computer programs are using what is called back testing, which is they go back and they say, oh, if I trade in this particular way by splitting this order and sending it to these markets, then using algorithm one, how well would I have done over the previous 6 months? Then they try algorithm two, algorithm three, algorithm four. So they try a whole bunch of combinations using data over the previous 6 months. And then they may find that, oh, algorithm three of this way of trading gives me the best results. So then they would take this algorithm three and then they will run it over the next month or two, right? So for you to actually trade today, you need to understand statistics because you are fitting models and you're forecasting. You need to know programming because you're going to be processing massive amounts of data. I mean, literally, hundreds of millions of observations on a regular basis. And you need to understand financial markets because at the end of the day, you can have all the programming skills, but if you don't know what you're programming, then it's garbage in and garbage out, right? So you need to understand markets and what variables to use in your forecasting model. So which means you need to understand finance. And the world is very complicated today. This is from the US, and you can see that there are so many different markets where Apple is being traded today. These are all different. All these names that you say here, these are all different venues one can send an order. And if you are designing this router, which is the trading algorithm, on where to send it and how to resend it and how to cancel and resubmit, then it requires a significant amount of knowledge in these fields. Okay, so you can immediately see the complexity. Then I want to just bring statistics. I mean, statistics is such an important part of finance when you're with numbers. So here I picked up stock of Tesla in 2019. This is January, February, March, April, May, all the way to December. This is the stock price. So you can calculate the return of Tesla here. For example, in February, you compare the stock price at the end of the period with the stock price at the beginning of the period divided by the stock price at the beginning of the period. That's the return that you earn. So in this example, the return would be negative 5.58. So these are monthly returns that you would have made if you owned Tesla. You can see some very large positive and very large negative returns. And so you can calculate the average of these. That's your, if you have a distribution, you have some good and you have some bad outcomes, and you can take an average of that. And that's what this arithmetic mean is. And the standard deviation, as you all know from your statistics class, is the deviation from the average, and that is your standard deviation. So this is your arithmetic mean, and this is your standard deviation for Tesla. And similarly, between 1926 and 2019, over a long period of time, you can calculate the standard deviation and arithmetic mean of returns from the stock market as well as the bond market. And this is what you're seeing here. So in the case of the stock market, you can see that the distribution is quite wide because it is more risky. Whereas in the case of the bond market, the distribution is very narrow because the standard deviation is quite low, right? So that's what you're seeing here. So you can see this is the mean and this is the standard deviation. You can combine this. So standard deviation is the risk. The mean is the return. And so these are points on a graph. And so in this case, you can see that the points are 18.6 and 12.1, 8.5 and 6.0. So you take these points and you can plot it in a graph where your y-axis is return, your x-axis is risk. And a standard assumption is that we like high returns, but we don't like risk. So what you would like to do is in this risk return framework, you would like to move in this direction where you get a lot of return, but with very low risk. Okay, and each of these points from this slide here are just points on this graph because they have a combination of risk and return. So you have bonds here, you have stocks here, and you have this person Kumar who's trying to move in this direction because that makes me happier because I'm getting more return for each unit of risk. And so if you take just these 2 points, then what finance will teach you is that you can combine them in a portfolio. So this is if you are only in stocks, if you're only in bonds, and if you combine them, then it's going to look something like this. Okay, and you can see here that you would prefer to be in this point rather than in this point because you have higher return here for the same amount of risk, right? So you can immediately see that this is an optimization that allows you to identify certain points here which are better. And how do you plot this particular what do you call an investment opportunity set? How do you superimpose Kumar on this investment opportunity set to find Kumar's point here? It all comes out of an optimization. And of course, we don't have time to go over this, but I just wanted to show you that this particular shape that you see here is coming out of this particular set of equations. And this Kumar's happiness function is coming out of this utility function where you like return and don't like risk. And so the optimization involves maximizing Kumar's happiness subject to the opportunities that are available. So you can set up these things mathematically, which is exactly what you would do. And then you would substitute and then you would optimize. For example, in this example, you're finding a maximum. And so you would do that by differentiating this equation, your objective function, setting it equal to 0. Now, this may seem very academic, but the beauty is that this is exactly what you would model in your program or using Excel. So in fact, one of the first assignments in my investments class is to actually give students these various points and have them come up with the set of these investment opportunities using an optimization. Okay, so these are the kinds of, you can see here it's mathematical using calculus here. And then finally, I just wanted to, given that all of us use smartphones and there's just so much data that's being collected, right? A lot of the data that's being collected is being used in the world of trading. So this is a article from the Wall Street Journal where they talk about how a hedge fund is using data, including data from Twitter posts and other types of location data to make a decision on whether to buy the stock of Best Buy. And you would buy Best Buy if you think, oh, Best Buy is doing actually better than what most of the other people think. But how do you find out whether it's doing better? Well, one way to do that would be to use some sort of location data and see, oh, are more people going into the Best Buy stores than they did at this time last year? Are more people searching on the Best Buy website than this time last year, and things like that, right? So all this data that we think are just sort of random noise is being purchased and processed by hedge funds and other types of investment firms because it gives them an edge when they decide which stock to buy and which stock to sell. And the only way you can really process all this data and put it into your trading models is by using programming and quantitative finance, right? So you can see that statistics, programming, handling large data sets, economics, they are all really part of the finance ecosystem today. And to the extent that you can have expertise in one or many of these areas, you can be very, very successful in finance by taking these ideas to a real world application, because you're solving some real world problems here in finance. So that's all I have. And I think we have a few minutes for Q&A. So Hari, I'll let you I'll let you guide me from here.
Thank you, Kumar. That was really fantastic because the way you brought it down to the level of school students or people who do not have the necessary background, it was fantastic. Thank you so much for doing that. And for the participants in the audience who joined in late, we will be uploading this talk on our YouTube channel in a week or so. So please, you can watch that later if you missed out on some parts of it, and you can also share it with others who you think would be benefited out of it. So what we can do is you can either send a chat as a question, or you raise your hand and I will unmute you so that you can ask your question. So we have questions coming in. So one of the questions is, so there is a student who is doing his undergrad, pursuing his BCom, and if we would have known the practices, so what should we do now to start um, getting deep into our fields and dig more values out of them? So he's saying that what if he's an undergrad student who hasn't had that much practices of Excel in this area? What do you suggest how they can start digging deep into these fields?
Well, I think there's so much resources now on the internet, right? So it'll be fairly easy. So many of these programming languages are open source, which means that you will be able to get access to it without having to pay a lot of money or licensing in order to practice it. So I think there are plenty of tutorials out there, and I would recommend that all of you spend some time becoming comfortable with at least one programming language, because once you know one programming language, you can easily pick the others because the logic in many cases is not that different. And so if you're starting now, I would say R and Python or Python are excellent places to start. And you can start slow, just start with the introductory material and slowly build your skill set. Same thing is true with Excel. I think there are a lot of tutorials out there with respect to Excel as well. And I think with all the resources available on the internet, you can easily learn. Remember that all of us started at a point where we did not really know much about a lot of things, right? And I think if you put in some effort, every day, you'll be surprised in just a month how much progress you'll make. I mean, it'll be very significant. And I would say that you need to have a good understanding of markets if you want to, if you're a BCom and you want to work in the area of finance. So which means that you have to read uh, a newspaper, a business newspaper, maybe Economic Times, right? And some business magazines on a regular basis. Because when you first start reading, there will be a lot of things that you don't understand. That was definitely the case with me. When I started reading, there were terms that I don't understand. It would be difficult. But if you keep doing it over a matter of just a month, you'll be surprised at how comfortable you become. So that's what I would recommend.
So there's a question on pursuing masters in finance from Canada or US, considering the cost is very high.
Mhm.
So what are your views on that?
I think Canadian universities are just fine. I mean, they are world-class universities, and so I think the quality of education that you would get from a Canadian university would be comparable to the US university. And so I think so you can make a decision based on both the cost, but also the outcomes coming out of the university. So it'll be a good idea for you when you are considering a program to collect information on the placements of those programs, and in particular placements of international students,
Mm.
um, and ask yourself whether the placements, that data that you have obtained, is something that you would feel comfortable with. Because we all have our priors on what is possible at the end of the program, but you need to confirm that your expectations are consistent with what the outcomes have been. But Canadian schools are fine. They're fantastic. They're well integrated with the curriculum in the US and Europe and other places. So I really don't have any concerns recommending Canadian schools.
And what are the other finance-based professions besides academia and financial analyst?
Um, so financial analysis itself is very broad because you can be doing so many types of um, roles could be very, very, very different. So even if you work at American Airlines, for example, right, you could be the person who's making a decision on which planes to buy. You could be the person who's making a decision on how to fund the planes, which would be part of the Treasury Department. You could be the person negotiating with the pilot unions on their contracts, right? So you're a financial analyst, but you're doing a lot of things just within American Airlines. So there are a variety of roles. We talked about working for a commercial bank. We talked about investment bank. We talked about corporate finance. We talked about trading. We talked about portfolio management, working for an investment company, right? So um, these are all roles where different types of skill sets become more important, right? So if you're in investments, if you're in trading, you have to be a real quant person because that's really where the world is. You cannot really be a strong trader if you do not feel comfortable processing large amounts of data, right? But if you are an investment banker, perhaps what's more important is your modeling and presentation skills using Excel and PowerPoint and things like that, because it's deal by deal. It's not really looking at a portfolio. So the skill set that you need there would be a bit different from if you're a quant working for a trading firm. So you should ask yourself, what are your strengths? Are you the person who wants to be in the front office pitching deals to clients? Or are you the person who likes to be in the back office writing complicated programs and handling large amounts of data? Because you have excellent career options regardless of what your answer is. But it needs to be a good fit with who you are, right? So you need to ask yourself who you are.
So for a student who is pursuing bachelor's in mathematical finance, is there a particular area within finance which is more of a natural fit, or b- given that their undergrad is in mathematical finance, they can dwell into any areas? Some areas within finance are probably a natural fit. So what is your opinion on that?
I think trading and investments. So in the world of investments, you are making decisions on how to build portfolios, what securities to buy, what securities to sell. Um, and in the world of trading, you're looking at how to execute the decisions to buy or sell, identifying mispricing across markets, implementing strategies where you buy the same security at a lower price, at the same time you sell the same security at a higher price because prices are not completely in line. That's called arbitrage. So if you are in mathematical finance, writing algorithms and programs to actually identify and take advantage of these kinds of opportunities clearly would fit with that. One thing I would recommend is for a mathematical finance person to spend some time understanding financial markets, because sometimes you get so much into the weeds of writing complicated mathematical models that you understand the mathematics, but you may not be as well versed with the real world that at the end of the day you're trying to participate in, right? So it's very important to understand the institutional details of the market, to understand how markets function, who are the players, how does money flow, how does information flow, right? Those are all very important things for you to understand, because when you're interviewing for a position, you can you will distinguish yourself when, in addition to having very strong quant skills, you also understand how markets work.
And is it possible to do a mid-career transition after having, let's say, 15 years of work experience in a different field?
For sure. I think, in fact, an MBA is typically, one reason students come back for an MBA is because they are looking for that kind of a shift, right? So they have work experience in one area, and they have enjoyed it, but at this point they feel like they would like to do something else, so they come back to retool and build the network that they need to make that transition. So I think an MBA program, at least in United States, where an MBA is typically not done right after your undergrad. You typically have many years of work experience before you come back for an MBA. One of the objectives of the MBA is to do that transition. Uh, Sometimes it can be challenging because if you have 15 years of experience in a particular field, you really are an expert. If you have 15 years of experience in a particular field, you really are an expert in that field. You're earning high compensation because of your subject matter expertise, right? And if you switch the field, then there's going to be an initial phase where you're still settling into that new field, and so there may be some sort of pay discrepancy that you'll have to navigate.
And what is the scope of actuarial sciences abroad? Because a lot of students are now interested in actuarial sciences in India, and it seems that in India it's still restricted in terms of career opportunities in insurance. I probably assume that there is still a lot of demand in insurance that is not yet met by actuarial science professionals. But in abroad, I believe that it's much wider in scope in terms of where actuarial science professionals work.
To be honest, Hari, I don't have much to say on that. It's not something that I have tracked very closely, unfortunately.
Mm, then- So, is it necessary that all finance-based professions require programming skills?
No, it does not. In fact, couple of things that we talked about in terms of jobs, uh, working as an analyst at American Airlines, right, where you're making decisions on which planes to buy or sell, things like that, or working as an investment banker at Goldman Sachs. Those are not the kinds of jobs where you really need programming skills. Those are the kinds of jobs where you need extensive Excel-based modeling skills, because you have to build out scenarios and cash flows for a particular deal. So if you're Goldman Sachs and you're working for American Airlines as a client, you have to build out extensive scenarios for American Airlines, for their top management, and help them understand which scenario is best for them. So there you're doing a deal by deal analysis. So what you need is extensive training in modeling in Excel and having great presentation skills, because at the end of the day, you're client facing and you'll be pitching to the client. So it's a very different skill set than the question on mathematical finance, Hari, that you just asked me a little bit earlier. Because with mathematical finance, you would be going for jobs in the trading area, in the investments area, which tends to be very quant oriented.
And what would be your advice to someone who is pursuing pure mathematics? How they can transition into finance? What are the things that they should do so that they can transition into finance?
So if you are in pure mathematics, you're really so well trained in terms of mathematical models. I mean, if you're in statistics, you understand a lot of the statistical tests, which tests you should use and when. Are the is the data consistent with certain properties of the assumptions of the model, things like that, right? So you're really well trained. um, I think what you really should focus on is understanding markets, and it may not be that difficult. You just need to start reading economic times and start reading some business oriented publications, maybe subscribe to some trade reports, right? Trade journals, financial analyst journals, some of these journals where the audience is not academic, but it's more industry oriented. And there's a wealth of information in many of these articles. And so it's going to take you some time. Maybe you say, I will give it at least 3 months before I get super frustrated, right? So for those 3 months, if you spend an hour every day putting in effort to understand how markets work, you'll be surprised that in 3 months you will have a really good understanding of the markets. Once you do that, then you can apply for quant finance jobs, because you have the mathematical training, but you also understand the industry. The problem is with many people who are mathematically trained is that they don't have a feel for the application that they will need to model when they're in the industry, and that's because they don't have a good understanding of the institutional details of the market. So for someone who's really strong in mathematics, I would say that understanding the industry, the finance industry, that you're interested in, the jobs that you're interested in, can help you.
Karthik Rajaraman, you have a question. Can you unmute yourself and ask your question?
Am I audible?
Yes.
Good evening, sir. Good evening, Hari sir. Also, so my question I think was about how you were going to forecast such models. You mentioned that forecasting is a very very powerful tool that is required in the finance domain. So, and I've read some of Dr. Taleb's work and how there is some problems in forecasting such some extreme events and irrational events. But it's also not possible to discount such events because there is a remote probability that they will happen. And so my question is, if you're building very mathematical models of financial markets and such markets, how will you account for those probabilities and how will you account for those events? In fact, I think banks doing stress tests is something that is mandated, but then what kind of scenarios can they picturize is a question that I think needs addressal. So what are your thoughts on that was my question.
Yeah, no, it's a great question. I think um, so to forecast, right, you have to base it on some assumptions, and one assumption that is very common is that historical distribution of a particular variable has some information about what will happen in the future, right? That's a very standard assumption. So we look at historical data, and in historical data, when we see certain patterns, then we use that to forecast. Now, I think the problem with stress testing in some of the black swan type events, the rare events, is that the rare events may not be in the data. So if they're not in the data, then you really don't view this to be a feasible outcome, so you don't really worry about it. And then, of course, events happen in the tail of the distribution, and when it happens, then you don't have the risk management in place to protect yourself in that scenario, right? So that's really the problem. I don't know if there is an easy solution to it, and in fact, the problem becomes particularly important as we become more and more quantitative, because we are relying more and more on some structure to the data, and typically that structure is borrowed from historical data. So I think what you have raised is something that is being thought about. I don't know if there's an easy answer to it, because at the end of the day, it's where your imagination takes you on outcomes that are not in the data that could potentially happen, right? So I don't know if there's an easy answer to how do you fix that, except to recognize that uh, in many cases, there are limitations with the data that you're working in, and therefore you have to think beyond simply using that distribution in your simulations, etc.
Thank you, sir. Thank you.
Param, you have a question. Please unmute yourself.
Sir, I was confused about the risk and return slide comparing bond and stock market.
Thank you for your question. So you can think about one version of the bond market is simply your bank account. So let's say you have 1 lakh rupees. You can put it in a bank account and on 5% interest, let's say, and that particular investment for 1 year, that 5% is guaranteed, right? So your return is 5%, your risk is zero, because unless something happens to the bank, which is not likely, you will make 5%. So that's an example of an investment in a low risk uh, uh, asset, where your return is guaranteed, uh, and the risk is low, but the return typically tends to be in expectations smaller than what you would earn if you put it in a stock market, for example. So if you put your money in Tesla, you might expect the returns from that investment to be higher, but at the same time, there's more uncertainty on what would happen. And so you have higher expected return because that's your forecasted return is higher. But at the same time, your forecast error is higher because, oh, the Tesla stock could explode and you can make a lot of money, or it could just crash and you could lose a lot of money. So both of those are possible over the next 1 year. So that's what the standard deviation is picking up. It's your forecast. It's your forecast of the error in your expectation, and you're trying to use both the forecast as well as the forecast error when you make a decision. And that's really what that return risk framework is. It's telling you that you have some options which are low risk, but they typically have low return. You have some options which are high risk, but they typically have higher return. And based on your tolerance for risk, you have to decide where you want to be, whether you want to be in Tesla or you want to be in the bank account in terms of your portfolio, or some combination of the two.
I also, when in the graph, it was if we had mostly a bond, but a small amount of stock market, we had less revenue but more risk than fully bonds. Why is that?
That's because of the correlation. The correlation is the association between the two assets, right? So if it's the case that the two assets that you're interested in, the two securities that you're interested in, they are in the same industry, then they tend to move together, right? And so so if you think about what is risk is the possibility that something could go wrong. And if you have a bad state of the world, if it affects all the securities in your portfolio in the same way, then the risk of your portfolio is very high. But suppose in the bad state of the world, you have one security that goes down in value, but you have another security which tends to go up in value. Then having the two securities in your portfolio reduces the overall variance of outcomes, because they tend to offset each other. Okay, so in state one, security one is high, security two is low. In state two, security one is low, security two is high. The problem is you don't know which state is going to happen over the next 1 year, but one of the two states is going to happen. So by having both in your portfolio, you can reduce the risk of your overall portfolio relative to just investing in one of the two securities. So that's really what you're seeing in that graph, because of the correlation structure between the securities.
Thank you.
You're welcome. Excellent questions.
Kishore had a question. Kishore, can you unmute yourself?
Hi.
Hey, Kishore.
I hope I'm audible. So I had one question with regards to the overload of information on the internet. So how would you actually streamline what to learn and what not to learn?
No, that's a really good question. When you work with big data, you have a lot of information coming your way, and you need to figure out what is noise versus information, and to sift that value relevant information. The way it's typically done is through back testing, Kishore. So what happens is that you have a lot of information, you have some priors on what you should keep and what you should throw out. So you run some models using back tested data, and you say, oh well, if I only keep this information and not that information, and I take it back over the last 6 months of data, how well does my prediction do? Then you bring in something that you've thrown out back into your model and say, hey, if I include this particular piece of information, how does my model do? Do I get more explanatory power, or is it just noise and my model's R squares, as it's called, goes down? And so you use some of your economic intuition on what you think is going to be useful, right? When you build a model. That's why I said, if you want to be in this field, you need to know programming, statistics, but you also need to know finance and economics, because at the end of the day, that's what guides how you build your model. Otherwise, it's just, kind of garbage, right? Because as the saying goes, if you look in data long enough, on the days in which it rains in Bangalore, the stock market in Bombay might go up statistically, right? But it makes no sense. There's really no mechanism by which rain in Bangalore will drive stock markets in Mumbai. So although it's there statistically, as an economist, you look at it and say, yeah, it's there statistically, but I just don't believe it. I just don't think it has predictive power in the future, because it's just a spurious association, right? So to answer your question, you use back testing, but your back testing is guided by economic intuition.
I think he was also referring to information overload in terms of the material available for learning.
Mm-hmm.
So how can one cope with that?
Oh, is that what your question was? Well, I would say, in terms of learning, I would say just start at the very beginning, right? If you're learning, if you're interested in learning Python, then you just start with the first tutorial on, Python, and then take it from there. But if you already have some knowledge, then you would obviously fast forward a bit and go to the next step. Is that your question, Kishore? I wasn't clear.
Yeah, that answers my question.
So Kumar, I have a question. I think this will be useful for students, especially who are in school. Um, I have seen a lot of Indian professors of Indian origin in finance, and typical background of theirs used to be, especially who came up in 90s, who did their PhDs 1990s, are the ones who did their engineering, or probably did their MBA, and then they came into finance. I think you're one of the exceptions who has an undergrad degree in business, and then you came for your PhD in finance. So it looks like people did their engineering and then they got interested in finance and came into the PhD program. But in your case, you probably got interested in finance earlier than many other people. So were you always interested in finance during your school days? Were you always wanted to be in academia? How did your journey happen?
It's a great question. So I think typically you will know if there is a particular field that you are, that's a better fit for you. Because as you hang out with your friends and you talk about, suppose you're in the business, undergraduate program, and some of your friends are going to be really excited about marketing. And in my case, I thought, yeah, marketing was fine. I can probably do marketing, but I was more excited about finance. I felt like it spoke to me, right? It kind of made more sense to me. And so that's how I got into finance. Um, but I got to say, for a PhD in finance, you just need a lot of strong mathematical training. And I think raising a mathematician foundation, I think, and everyone who's participating here, obviously coming from a strong math, calculus type background, it makes a huge difference for you to actually succeed in the PhD program. Because a PhD program is not like an undergraduate program or a master's program where if you enter the program, you're necessarily going to exit with a PhD. More than 50-70% of students who join a PhD program never complete the PhD program, right? Because they cannot get through the coursework. They do not get through their qualifying and comprehensive exams in many cases. So you really need to be trained in quant, in terms of calculus, ability to do some optimization, constraint optimization, things like that. And I think the fact that I was in an engineering school, although I was part of management, the coursework there was very rigorous in terms of mathematics. And so I think that really helped me when I joined the PhD program, because although I came from a business background in finance, I actually took courses with all the engineers. And so, I felt that it helped me a lot in my PhD program. Once I joined the PhD program too, to be honest, I was quite clueless in terms of what area I would really go and specialize in. There's so much that you don't know, even if you've completed your undergraduate degree in and you worked for a year in finance. There's just so much more out there. There's just topics and ideas and just not been exposed to at all. So when you join the PhD program and you spend a year and a half in the program, you just learn so much. And at that point in time, I started gravitating towards trading. I just found it fascinating. I mean, I just really enjoyed the studies that I read on trading, and I found that my friends who were in the PhD program, they were like, trading is fine, but it's really not that interesting. They were interested in something else. So it's very, it's almost like the field speaks to you, because as you start spending more and more time, there are going to be certain topics that you will find fascinating, but your friends may not find fascinating. And so when that happens, then oh, this is maybe I should pay more attention to this, because this may be an area where I can probably actually pursue my career. I'm very passionate about this, more so than the other people. So I think it's fair to say it's all tiny steps along the way. Really, I mean, I had no idea, first of all, that I would be an academic. In fact, if I talk to my high school friends, most of them, the first thing they tell me when they see me is, gosh, I can't believe you became a professor. Nobody thought that you're going to be a professor, right? So I think that's really the case. And you make decisions, slowly over time as to what you go towards. And so that's what I would recommend to everyone here. Everything is baby steps, and you're slowly moving in the direction where at some point in time, you would be someone who know a lot about a topic.
That's very helpful for us to know. Generally it can get overwhelming of how do you decide, and when you look at accomplished people, it just you feel that they knew all the way, right from a young age, what they wanted to achieve. So this is really useful information. So on that note, I think we will conclude our session. So I would like to invite Vaibhav Hariharan to give a vote of thanks to our speaker today. Vaibhav, are you there?
Hello,
Yeah.
sir.
So
Hello.
Vaibhav is recently finished his chartered accountancy, and he secured an All India rank 2 this year. And
Wow, Vaibhav, congratulations! That's awesome, fantastic.
and
Thank you so much, sir.
he's from Dombivli.
Oh,
And
there you go. One more Dombivli product.
he attended the MAT.com, that is Application of Math in Finance and Economics workshop a few years back. And in fact, the study material that we use is actually written by him for that program. So Vaibhav, please give your vote of thanks.
First of all, good evening to everyone who attended the session. So first of all, I would like to thank Raising a Mathematician Foundation for organizing this program. It has been a really great session. This is the first expert talk session which I have attended, and I have got a lot of inputs from it. Secondly, I would like to thank Kumar sir for sharing so many detailed insights into the field of finance. And thirdly, I would like to thank Venkataraman sir for sharing so many insights into the field of finance. Hello, am I audible now? There was some internet issue.
Yes, Vaibhav.
Yes. Secondly, I would like to thank Kumar sir for sharing so many detailed insights into the field of finance. The way he escalated from a household to a corporate, from personal financial planning to corporate financial planning with such relative ease that even a school student could understand, that was really phenomenal. And the way he brought the interdisciplinary connections between the quantitative areas of statistics and the information technology related areas, and also how economics, qualitative analysis, economic intuition, and even human behavior plays a very important role in making financial decisions. That is really great. For me, the greatest takeaway was that each situation which you face in the field of finance is unique, and there is no single possible solution. Every person could come up with a different solution, and even in the end, you don't know what is going to be the actual outcome. You can only evaluate your decision in hindsight. That is a really very fascinating point about finance. And I would also like to thank sir for addressing so many of our questions patiently towards the end. And I would like to thank the entire audience for patiently attending the session, for taking their inputs from this session, and for raising their questions, which provided insights not only to the person asking the question, but also to all the other attendees. Once again, thank you to everyone.
Thanks, everyone. It was really my pleasure, and it was thanks again to Hari and the other organizers of the session. It was really a pleasure. Thank you.
Thank you, Kumar. So we'll meet for the next expert talk. We will get in touch with you for the next series of talk. Thank you so much. Bye bye.
Thank you so much. Bye.
Bye.